at the height of the global financial crisis, when trust in banks was fragile and governments were still cleaning up the wreckage, one institution stood above the rest: JPMorgan Chase, the fortress balance sheet, the best-run bank in the world, the one bank that didn't need a bailout, the gold standard of risk management. And then it lost $6 billion, not from a rogue trader, not from fraud, not from a market crash, but from its own risk management desk. And at the center of it all was one man, a quiet French trader in London known as the London Whale. This is the story of how one desk nearly took down the most powerful bank on earth. To understand why this mattered, you need to understand the context. After 2008, banks were under enormous pressure to reduce risk. Regulators demanded stronger capital buffers. Investors demanded stability. Politicians demanded accountability. And JPMorgan, under Jamie Dimon, positioned itself as the adult in the room, the bank that got it, the bank that understood risk. And nowhere was that confidence more visible than in the chief investment office, the CIO. The CIO wasn't supposed to be a profit machine. It existed to manage the bank's excess deposits, to hedge risk, to protect the balance sheet. It was, in theory, conservative, boring, safe, but over time, it became something else. It became a trading operation. By 2011, the CIO was managing hundreds of billions of dollars. It was generating real profits, and it was taking real risks under the banner of hedging. And inside the CIO in London sat Bruno Iksil. Iksil was not flashy. He wasn't loud. He didn't look like a Wall Street movie character, but he was huge in one sense: size. His trades were enormous, so large, in fact, that other traders began to notice, and then they began to joke, and then they began to worry. They called him the London Whale, because when he moved, markets moved. Iksil was trading credit derivatives, specifically complex positions tied to corporate default risk. These are instruments that banks use to insure against companies going. In normal size, they're a risk management tool. In Iksil's hands, they became a market force. He was placing positions so large that hedge funds could see them in the market. And when hedge funds see a giant position, they do what hedge funds do best: they attack it. By early 20, traders at firms like Blue Mountain and Saba Capital had identified JPMorgan's position. They could see it, they knew where it was, and they realized something critical. This position was too big to move quietly, and that meant it was vulnerable. They began trading against it. At first, JPMorgan didn't panic. The CIO team believed they were hedged. They believed the positions would pay off. They believed the market was wrong. But the market doesn't care what you believe. As spreads moved, losses mounted, quietly at first, then visibly, then alarmingly. Inside JPMorgan, alarms started to ring. Risk managers flagged the positions. Concerns were raised. Questions were asked. And then something extraordinary happened. Instead of reducing the position, the desk added to it. They doubled down. Why? Because admitting the loss would mean admitting failure. Because closing the trade would mean crystallizing the damage. Because psychologically, traders and managers fell into the oldest trap in finance: if we just hold a little longer, it will come back. But it didn't. By April 2012, the losses were no longer containable. And then Jamie Dimon went on an earnings call. An analyst asked about rumors of a problem in the CIO. Dimon dismissed it. He called it a tempest in a teapot. That phrase would haunt him, because weeks later, JPMorgan was forced to admit the truth. The bank had lost over $2 billion, then it was $4 billion, then it became $6.2 billion, $6 billion from a desk that was supposed to be managing risk. The market reaction was brutal. JPMorgan stock fell, confidence cracked, regulators swarmed, and suddenly the best-run bank in the world was being compared to the very institutions it had mocked in 2008. This wasn't supposed to happen, and the fallout was massive. Jamie Dimon was dragged before Congress. The Senate launched an investigation. The media tore into JPMorgan's culture. What went wrong? The answer was deeply uncomfortable. The CIO had become a profit center, not a hedge. Risk limits had been loosened. Models had been altered. Warnings had been ignored. At one point, the bank even changed its own risk metrics in a way that made the positions look smaller than they were. This wasn't a rogue trader story. This was a systemic failure. A failure of oversight, governance, culture, and accountability. And at the center of it all was Bruno Iksil. But here's where the story gets really interesting. Because Iksil didn't flee, he didn't hide, he didn't deny, he cooperated, he became a witness, and in doing so, he exposed something even more damaging that senior managers had known far more than they admitted. Emails surfaced, internal documents emerged, and the narrative shifted. This wasn't one trader's mistake. This was a chain of decisions. Up the ladder, very far up the ladder, 2 JPMorgan traders were later charged criminally. Both cases collapsed. No senior executives went to jail. No one at the top lost their career. Jamie Dimon kept his job. Bruno Iksil, he walked away. No prison, no lifetime ban, no exile. He returned to France. The man at the center of the biggest trading loss in banking history simply disappeared from the public eye. And that's why this story matters. Because the London whale trade wasn't just about money, it was about power. It showed that even the most sophisticated institutions can lose control. It showed that risk management can be overridden by profit. It showed that size itself becomes a risk. When you are too big, your trades distort the market. When your trades distort the market, others will exploit you. And when others exploit you, losses can spiral. The irony is brutal. JPMorgan survived 2008 because it was conservative. It nearly broke in 2012 because it wasn't. And the most unsettling part, $6 billion didn't sink the bank. It barely dented it, which tells you something terrifying about scale. If a $6 billion mistake is survivable, how big does a mistake need to be to matter? That question sits at the heart of modern finance. Today, banks are even bigger, derivatives markets are even more complex, and algorithms now move faster than humans can react. The London whale wasn't an accident, it was a warning about concentration risk, model risk, cultural risk, and the illusion of control. And in a world where one desk can move markets, the line between hedge and gamble is thinner than anyone wants to admit. So the next time you hear a bank say, this position is risk management, remember the London whale. Because sometimes the biggest dangers in finance don't come from outsiders. They come from inside the building. If you want more stories about the hidden mechanics of markets, the people behind the trades, and the decisions that shape global finance, hit subscribe. And if there's another story you want me to break down, rogue traders, hedge fund blowups, financial disasters, drop it in the comments. Because in markets, the real stories are always the ones you're not supposed to see.